Hello all, good day to everyone. My name is CA Lakshmanan. In this video, we'll see how to file Form 67 in income tax. Let us quickly understand in short what exactly is the use of Form 67. Let's assume the assessee is a resident in India and hence all the income throughout the world will be offered to tax in India. Now he has a foreign income in a foreign country, and according to that foreign country's law, he would have paid tax on the same, which is called foreign tax. Now, while this income is offered again in India, an income tax liability arises in India, right? So against that liability, that foreign tax which has paid in the foreign country can be reduced based on a calculation. Now, this is called foreign tax credit. And for doing all this in the income tax returns, while filing income tax return, beforehand itself, we will have to intimate the income tax department stating that so and so is my foreign income in such countries and I have paid so and so foreign tax in that country, and this is the amount of credit that I will be availing in an electronic format. And this particular electronic format form is called Form 67. So Form 67 is basically an intimation form which we will be intimating to the income tax department stating our foreign income's nature, amount and the tax paid on the same. In order to understand Form 67 in a clear manner, it is better if we preliminarily understand few terms. The first term is double taxation. What is double taxation? There are two principles in taxation. One, residence-based taxation. Two, source-based taxation. So in residence-based taxation, the taxing rights predominantly lies with the country in which the assessee is resident. In source-based taxation, the taxing rights predominantly lies with the country in which the assessee actually earns the income. India follows both these approaches. Say for example, if a particular assessee is resident in India, then his global income is taxable, which means even the source country in which he earns, that particular income is also offered to tax in India. For a non-resident in India, only those incomes which he earns within India is taxed in his hands. This is the general understanding. So for example, let's take an assessee in India has various incomes in India which will be offered to tax in India, as well as if the same assessee has a house property in US and he is receiving rental income from the same, that rental income will also be offered to tax in India because he is resident in India. Now, since he is earning that income in US, there are chances where he will be paying tax for the same in US also. So the same rental income is offered to tax in US, it's offered to tax in India, and it's taxed in both the places. This is called double taxation. How can this double taxation be avoided? According to Indian Income Tax Act, there are two types of relief that is given to avoid this double taxation. Number one, bilateral relief, section 90 and 90A. Number two, unilateral relief, section 91. What is bilateral relief? Now in the previous example, we took India and US. So these two are called contracting states. Now the contracting states enter into an agreement to avoid this double taxation, and that is called Double Taxation Avoidance Agreement, DTAA. The Double Taxation Avoidance Agreements, DTAA, will have various articles. Each article will talk about a specific nature of income and which country has the taxing rate and what rate would it be. That will be the general content in the DTAA. Generally, the resident country will be given the rights to tax, whereas if for the same income, if resident country is also given the right to tax and if the source country is also given the right to tax, then there occurs double taxation, right? Now in these cases, we can use this foreign tax credit to reduce the resident tax liability by whatever amount has been paid as foreign tax according to the calculations. Now this is bilateral relief. What is unilateral relief? Unilateral relief means the countries with which India has not entered into such agreements And if in those countries the assessee has paid some tax, then that can be considered as unilateral relief. It is the same foreign tax credit only, but it is considered as unilateral relief. For example, Cuba. So India has entered a DTA with US, whereas it has not entered a DTA with Cuba, and hence this is bilateral relief, this is unilateral relief. The various methods to eliminate double taxation is exemption method, credit method. Under exemption method, there are two types, exemption method and exemption method with progression. Under credit method, there are two types, full credit method and ordinary credit method. In full credit method, it means whatever amount has been paid as foreign tax, that will be entirely allowed as foreign tax credit deduction. That is full credit method. Ordinary credit method means there is a calculation that revolves around how much foreign tax to be allowed as credit. So India ideally follows this ordinary credit method, whereas with few particular types of income in few particular countries, India also allows exemption method. So predominantly it follows ordinary credit method with exemption method in few cases. The topic that we are dealing with is foreign tax credit, right? So what is foreign tax? Rule number 128 basically deals with foreign tax credit and the form 67. So country other than India in this context is foreign, and any tax paid in that country is called foreign tax. But now the countries with which India has DTAA, in that particular cases, foreign tax means the amount that is paid as tax in that particular country, but it is limited to whatever rate is mentioned in DTAA. Say for example, for a particular income, the rate in DTA is 20%, but the assessee has paid 30% as tax in that particular country, just for an example. Then the 20% rate tax amount only is considered as foreign tax for the purpose of foreign tax credit calculation. Now, with the country with which India has not entered DTA, that is for example Cuba, whatever tax has been paid in that country is called foreign tax for the purpose of foreign tax credit calculation. The year in which foreign tax credit can be claimed is, let's assume the assessee has earned income in a particular year in that foreign country. When the same income is offered to tax in India, in that particular year only we can avail this foreign tax credit. So ideally the understanding is this: in whichever year we are offering the income, with respect to that, the deduction can be taken for that in that particular year. So that is the logic. Against what is this credit allowed? So while filing income tax returns, generally after calculating all the total incomes, we calculate the total tax liability. So against income tax, surcharge and cess, this foreign tax credit can be subtracted, whereas it is not against interest, fee and penalty. Now let us look at an example for understanding how is FTC calculated. Let's take an assessee who is resident individual in India who has other incomes taxable in India to 28,20,000, and in a country, in a foreign country, he performs services and he earns an income of 7,50,000, for which 1 lakh has been deducted as tax in that particular source country. So India's resident country, let's assume for example it is US, and he earns 7,50,000 in US, for which 1 lakh is deducted. Now the foreign tax paid is 1 lakh. How much the foreign tax credit that can be allowed is, now let's total both the incomes, 28,20,000 and 7,50,000, which amounts to 35,70,000. Let's assume the tax on this total income is 9,18,840, and hence the average tax rate is 9,18,840 divided by 35,70,000, which is 25.74%. Now this 25.74% average rate of tax is multiplied against the income derived from the foreign country, which is 7,50,000, and which will be 1,93,050. So tax in India on that particular foreign income is, according to the 25.74% is 1,93,050. But what is the tax that is actually paid to the foreign country? 1 lakh. So 1,93,050, 1 lakh, whichever is lower, that is 1 lakh. And hence the foreign tax credit allowed is 1 lakh. So what is the total tax liability including the foreign income? That is 9,18,840, against which we can subtract this 1 lakh. Hence the total tax liability is 8,18,840. Now this 1 lakh is called foreign tax credit. So the foreign tax credit is basically whichever is lower, that is the amount paid outside India, or the tax in India on that particular foreign income using the average rate of tax. This is nothing but ordinary credit method. In order to claim FTC, the following documents are required. Form 67, which has to be furnished in electronic format. Along with that, the following attachments are to be made. In the source country, either from the tax authority or from the person responsible to deduct the tax, we will have to get the statement of income and the tax from that country. It should be signed by the assessee and accompanied by acknowledgement of online payment or bank counterfoil or challan for payment of tax where the payment has been made by the assessee, and the proof of deduction where if the tax has been deducted. The time limit to file Form 67 is before filing the income tax returns in India under Section 139. So before filing the ITR, Form 67 has to be furnished to the Income Tax Department. These documents shall be furnished in the year in which the income has been offered to tax or assessed to tax in India. Because whenever we are offering the income, on that particular year only we have to take this deduction as well. That is the logic behind this particular condition. Form 67 can be basically divided into three parts: Part A, Part B, verification. In Part A, these are the basic details that will be auto-populated in the portal: name of the assessee, PAN number or the Aadhaar number, address and the assessment year. The next information that will be filling in Part A is the details of the income from the country or specified territory outside India and foreign tax credit which will be claimed for the same. So basically this table will have first the country from which we have earned the income, second the source of income, be it salary or house property. So we'll have to fill country wise and the source of income wise also. And so what is the income amount and what is the tax paid outside India, the amount and the rate. And the next two columns will be tax payable on such income under the normal provisions in India. Recollect the example that we have seen earlier. And tax payable on such income under section 115 JB and JC, which is MAT and AMT. After that we'll have to fill credit claimed under section 9090A, which is nothing but the bilateral relief, that is the countries with which India has DTAA. Remember, India and US. So for that we'll have to fill three data for that: the article number in the DTAA, rate as per DTAA, and what is the amount of credit that we are going to claim. If there is no bilateral relief, then we'll be going for unilateral relief, Cuba. So the next column is credit claimed under section 91, which is unilateral relief. Ultimately, the credit claimed under section 9090A and 91 is added, and these two together is called total foreign tax credit claimed. Hence, in this particular table is the heart of Form 67, wherein you will be filling the details country wise, and for each country the source of income, the nature wise, and we'll be filling what is the amount earned, tax paid in that country, and what is the amount of tax as per the normal provisions in India, AMT, MAT amount, and the credit that will be availing. And finally, these two credits, that is bilateral relief credit and unilateral relief credit, will be summed up together, and all these will be totally summed up finally, which is called the foreign tax credit. The part B of Form 67 basically has two questions. Question 1, if there is any carry backward loss in that foreign country. Question number 2 is if the foreign tax amount paid in that country is under dispute. So both of these are beautiful concepts. It is an yes or no question. If while filing the form we click yes, then there are subset questions that are asked for the same, which has to be filled. Let me quickly explain what is the concept of that carry backward question alone. So carry backward loss is a concept which is not prevailing in India, but in foreign countries. Let's say, for example, the assessee has earned 100 rupees, 100 rupees, 100 rupees in 3 years, and he has paid tax of rupees 10, 10, 10 in 3 years, against which the same 100 rupees would have been offered to tax in India, and he would have paid tax for the same in India. And according to the foreign tax credit calculation, let's assume he has considered the 10 rupees as foreign tax credit, which means whatever he has paid there, he has subtracted in Indian income tax liability for the past 3 years. Now, in the foreign country, in the 4th year, he has made a loss of say 50 rupees. And what happens here is, he can carry backward that loss and he can adjust it with a profit of 100 rupees in the previous years, which means his tax liability for the previous year is now only not 10 rupees, only 5 rupees. But in India, he would have already claimed this 10 rupees as foreign tax credit, right? So now that has to be reduced, because now the foreign tax paid is not 10, it's only 5 rupees. And hence, in the Indian income tax liability, we'll have to reduce the same in the previous year, correct? So in order to do that, first we'll have to intimate the department here in this particular point saying, yes, there is a carry backward loss. And the next questions that will be asked is the accounting year to which the loss actually pertains, that is the 4th year in the example. The accounting years to which the set off backward of loss has been undertaken, that is nothing but the 3rd year in this example. Refund claimed for the accounting years, that is in that particular 3rd accounting year we would have claimed a refund of 5 in that foreign country, right? So previous year to which the refund referred to in 3 relates, that is the previous year in which the in India. So that particular previous year they are asking about. Now if we all have to fill all these details, and as far as I have read, there is no specific provision given for doing this particular correction in Indian income tax. So the choice that we have to choose here is section 154 rectification, and we'll have to open that particular assessment here and again file it under section 154 is what I have read and understood. Now the second question. Foreign tax paid is under dispute in that particular country. Now, while filing Indian income tax return, we would have claimed this as foreign tax credit, but we should also inform in Form 67 what is the nature and amount in respect of which it is disputed, the amount of such disputed tax. We can claim foreign tax credit, but once the dispute is over in that particular country, it's the responsibility of the assessee to intimate the department within 6 months after the dispute is over. The intimation that has to be done is stating that the dispute is over and proof for the same. Also stating that so and so tax, whatever has been claimed, has actually been paid as after that dispute. Third, no refund shall be claimed from whatever tax has been paid in that foreign country. So these has to be mentioned to the income tax department within 6 months after the dispute is over in the source country. Finally, after part B, it's the verification screen in which we will have to fill our name, father's name, PAN number, place, date, and then the capacity as self or whatever respectively is required. And finally, we can give confirm and submit in the online portal. All the screens in the IT portal has been taken a screenshot and the same has been attached in the PPT. The link to the PPT is available in the description in the YouTube video. Thank you BCAS for providing this wonderful opportunity for making this video about Form 67. People who have feedbacks and suggestions can provide the same in the following email ID: bcastaxation@gmail.com. That is BCASTAXATION@gmail.com. Thank you all. Have a wonderful day. Take care.